to have that sense of confidence, actually confidence in your craft. And I think that's beautiful.
There is a significant non-zero, probability of you losing all your money. Imagine being a crorepati before the age of 30. Flipkart did, their liquidity, and there were 19,000 employees, I believe, who got, a part of the, 700 million or 900 million.
How should one think about the market cycles broadly when they're designing their personal portfolio?
What we're seeing across the board is a systemic shift in terms of the risk that every individual is willing to take.
And I think my counter question to that is most of us work in really demanding jobs. If we can do what we do, I don't see why we can't do that with our money.
Our core insight was that people want a sense of learning, accomplishment, and control when it comes towards their money. Caution that I want to throw to everyone is please.
Welcome to the India Opportunity Podcast. Hello and welcome everyone to today's episode of the India Opportunity Show, where we explore conversation with the visionaries transforming India's business landscape. I'm thrilled to introduce you to our guests today, Ankita and Joy, the co-founders of Infinyte Club, a platform that's redefining how individuals approach wealth creation and private market investing. Ankita and Joy bring an incredible mix of expertise. Ankita was previously at Unacademy, Zivame, and Coupon Dunya, and founded one of India's first food tech delivery startups called Delivery Chef. And Joy is one of the most brilliant product minds of our country. She had a long stint with Sequoia Capital and Surge as the Vice President for India and South Asia, and worked in different product roles prior to that. If you are a user of Infinyte Club, I'm sure you can vouch for the product magic that they've been able to create. Together, they've built Infinyte Club into a trusted platform, executing over 60 deals with over 10 million in invested value, and are fostering a vibrant community of top-tier talent from some of India's leading companies as investors. Today, we are going to do a deep dive into their journey, the evolving landscape of private markets, and the future of wealth tech in India. So let's get started. Ankita and Joy, welcome to the show. I'm personally super excited about this one because I love that the tribe of women investors is growing in our country. And I'm sure this conversation will inspire so many more women to join us on the investing side. There have been many deals where I've been the only woman on the cap table, and I'm sure that's true for you too. But it's amazing to see this change happening up so close, which has led us here to talk about all things investing, wealth creation, and the private markets.
Thank you, Shrishti.
Awesome.
Excited to be here
I want
today.
to start with a quote from Naval Ravikant, who's the founder of AngelList and the OG in the tech world. You are not going to get rich renting out your time. You must own equity, a piece of the business to gain your financial freedom. Let's start from there. What was the intrinsic motivation for both of you to dive into the world of private markets to help young folks get access to high quality businesses?
That's awesome. I think, Joy and I often say this, right? That absolutely nobody in the world ever got rich without ownership, right? It's ownership in businesses, ownership in companies that actually makes you wealthy. You're never going to get wealthy on a salary, right? So, people express ownership in different ways. Some people, they will either, work at companies that give them equity. Some people are investing in the markets, right? Or, buying the index. That's also ownership. So it is compounding of wealth happens only when you own companies. So it's bang on, right? So what motivated us to get started on this journey, I think when we came together and decided we want to build together, we always, the world of wealth creation really fascinated us. And what we found was that, there were two ends of the spectrum that exist, right? Currently, or at the time, in the available suite of wealth management products. On one hand, you had, like, DIY platforms, which is great for people who know what they want to do. On the other side, you had white glove services for individuals who are ultra high net worth individuals. And but there was this large gaping hole in the middle for people who have investable surplus. They are intelligent investors, but they don't have the right tools or the information available to make informed decisions. So I think that's the point that really struck us to say, okay, is how can we solve this problem of finding the right places to invest, at the same time building a product that enables this intelligent investor to come through into the investing world.
Just to add to that, right, I think we often say this, that no one gets wealthy on a salary. And I think that is something we've seen in our journeys as well. I saw that from a product perspective, like, here I was sitting with all of these amazing tools, right? Whatever you want to do, you want to do cohort analysis, you want to send out an email, you want to know how something is doing. You just have all of those tools, but somehow for money, there just wasn't anything that really served my purpose. When I looked at how I managed my money, it was somewhere in between DIY, these apps, some money manager always trying to pitch to me and tell me that I don't understand enough, and then me calling Ankita and saying, "Hey, can you tell me what I should do and what are others like me doing?" So in the triangulation of that is where we actually found our sweet spot, and turns out it's a problem that not just Ankita and I have, but many like us. And that's how we actually got started, right? Like we just said, look, there are all of us in this startup ecosystem. We're so close to solving really interesting problems, hard problems. We have ownership. And yet we somehow seem to miss the boat when new and interesting either companies come up or new and interesting financial products come up. And we're somehow left out of that story. And how do we kind of become a part of that story
Yeah,
as well?
absolutely. And, just give our audience some context on how you both came together or how you decided that you wanted to work together as co founders, because that in itself is a big decision. And to take that leap of faith, you are betting on each other to be able to grow this business together. So let's talk about that founding story as well.
I have to say this. The first time I met Ankita, and we started out as friends, right? The first time I met her at a common friend's birthday party. And it was the first time I was meeting her. And I just remember this feeling that I have to work with this woman at some point. That was the loudest thought I had that evening, right? And I think that must have been at least now. I think I'm thinking 7 years ago, right? And I never thought it would come. We would eventually find our way from being friends to being co-founders. I came from this product and tech background. Anki was, doing business and revenue, and we used to always jam on these ideas of saying, okay, what are these interesting problems that we're seeing around us? And just like most operators like us, we had ideas, we had insights, we didn't have the money to invest, so we would do whatever was the next best thing, right? Which is jam on growth and product, and how could we have done this differently, and how could we do this better? And that's how we actually got started. Both of us were very passionate about education. At one point, we thought we would do something in education. We thought we'd do something about bringing more women back into the workforce. And then I think the clincher of it was, hey, actually, it's money, right? It's wealth. And why wealth? Why money? It unlocks potential like nothing else ever does. That's how we came together on that, and that's how we started jamming. And then, well, here we are.
No, I think we were fortunate to have known each other well before we got started on the journey of becoming co-founders, and I think that really helped us, almost very organically discover each other's, values. Do we think alike? Where do we think differently? Where do we, how do we disagree? How do we disagree and commit? Where do we agree? Where are we on the same page? And it really, I think a lot of things, we always talk about this, when people ask what's it like to have a co-founder. It's like it's a second spouse, right? And it's as tight of a partnership as than that. Joy said the other day, someone asked us this question, and she says she's my ride or die, and it's true, right? We literally have to, we actually spend more time together than with our partners, right? So it's yeah, I think us having come together before made a huge difference to allow us to really be solid
And let me
co-founders to
just
each other.
double click on that, because Joy, you said that, when you met her at that party, you knew you had to work with her. What was it about Ankita? What was that vibe that you got from her that you decided that you wanted to work with her?
Yeah, I've often thought about this. I think she's, I call her Spunky, okay, because and most people don't know this, and we end up calling her Spunks. And it's just that she has this vibe, this naughty, mischievous vibe about her, and she's always up to something. She has a bright idea. You can see it, like you can see that in her eyes. Like, okay, I can. So even when we're jamming, so we'll be talking. I'm usually on the extreme crazy side of things, and she's usually on on the more like, okay, how do we make this happen? How do we monetize this? How do we think about growing this? How do you think about scaling this? And I'm usually on the other wild cowboy side. And And then I can see that there'll be something that runs across her face. And I'm like, wait, that thought, tell me what it was, because that is the spunky moment, right? Like that is what is going to change the game for us. And that's exactly what I saw when I first met her. And it's interesting because we have very complementary skills. Like I've always worked in engineering, product, tech, design. She's worked in business, revenue, monetization. And I will say this, like, I think the best part about this is I have a co-founder who thinks about monetization from day one. It's always like we're thinking about a product and we say, okay, how do we monetize this? How do we scale this? How do we grow this? Is this even going to be sustainable? And I think that's what I saw. And we got started. We are talking about, okay, like, hey, what are we doing? And I was like, wow, I love how this woman just talks about, her area of expertise. To have that sense of confidence, to have that sense of deep, actually, confidence in your craft. And I think that's beautiful, right? And that when you meet that, you respect that, you love that, you appreciate it, and that's when the spark gets going.
Amazing. Ankita, I'm sure that's making you feel really good right now.
No, it's really touching. But I think I'm on the other side of things, right? Like if you ask me, I think Joy's reputation preceded her, right? I think she is by far uh, the country's best product and tech person, operator you can find. Or you cannot find
Yeah.
someone better than Joy in the country, uh, and everyone knew this. Okay, so I think I always knew I wanted to start a company, but I knew I didn't have a complete skill set to build a tech product. I had, one part of the equation, but I did not have a large part of the equation in my mind solved. And when I met Joy, I was like, wow, this girl is so smart. And you know what? I'll just tell you this. Her former employer did not let her leave for 9 months, okay, from the time that she said that she wants to get started. So I think that's how tightly people want to hold on to her
Yeah.
because they know she's brilliant. So I think we just knew. I think it was
Yeah,
a
and
perfect
I can
partnership.
totally vouch for that. Even while I was at Meta, and I remember we were talking about something to do with Sequoia Capital and working with Joy. And, I think it was echoed in the room that, she is one of the best product minds of our country. And I'm saying this in our intro also for this episode, by the way. So it's something that I really mean, not just saying it for the sake of saying it. And Ankita, I think every interaction of yours, I've also learned so much about the private investing markets and how you were thinking about the business. I think both of you are true powerhouses coming together. And the reason why I asked this question is because, we've been in the startup world long enough to know that, most startups die because of co-founder conflicts, right? So getting that right is possibly the most critical decision that you can make in a startup journey. And you seem to have got it right. And I think a lot of people can learn from this that, you should look at complementary skill sets and, in terms of what someone has done before or what their perception has been in the market before also really matters sometimes when you go out to raise funding and have investor conversations, those sort of softer aspects as well. Let's now talk about the fact that start investing in startups is highly risky and illiquid. A lot of people who've started investing on platforms or angel networks do not have the understanding of what they're getting themselves into, and they may have been misled into investing into this asset class as well. What is your advice to someone who's just getting started with investing in startups, and what are realistic expectations to have from this asset class?
Great question, Shrishti. I think first of all, before I answer this question, I want to underscore that startup investing is not for everyone. Right? It is absolutely highly liquid. It's really binary. There is a significant non-zero, probability of
Yeah.
you losing all your money. Right? And there is such a thing. It is very, very, very risky, and it's not for everyone. Only people who can stomach that risk should be getting into it. I think that said, that there is a right way and a wrong way of doing it also. So let's talk about what right way and the wrong way is. So let's talk about a typical person who is starting to invest in startups, who thinks about investing. So who's this person? This person's probably just come into a certain amount of money or broken into senior management at a firm and says, you know what, I want to get started on building or building a startup portfolio or a private investing portfolio. So what will they do? Firstly, they will start and they will say, okay, let me start with 3 to 4 lakhs per company, because honestly, that's the
Yeah.
minimum sort of check size that you can write if you have to approach company by company. They'll make one investment, two investments, three investments. At the end of the year, they've invested, let's say, 9, 10 lakh rupees across startups. But at the end of the first year, your first company has started to go bust. Okay. And the person's natural thought is, okay, let me slow down on this, and let me just take it a little slower. Because that loss, it feels
Yeah.
really, really heavily on a person. They don't make any more investments for the next, let's say, 1 year, and 2 years into startup investing, you've lost all your money, right? And that's how that this is a tale as old as time, Shrishti. Okay, you'll hear this story over and over again from different people and different versions of it. So the only way to do startup investing right is to have a portfolio approach, right? If you only when you build a portfolio of startups is when you will have a few of them which will really outperform for you and will recover the money that you will lose in the others that will not make it, and then some, right? And it'll give you the alpha that you are seeking in the first place. So please don't get into startup investing if you plan to invest in two and three companies and see how it
Yeah.
goes. I will tell you where it goes. It goes with you losing all your money, right? So that's one aspect of it. You have to build a well diversified basket. The second part of it, okay, is access, right? It is not all deals are the same, right? The best quality deals, it's important in startup investing to identify these best quality deals, right? Or to have access to the top quality founders. Now, the top quality founders are usually not accessible to common folk. Okay, they get swooped up by top tier VCs and super angels who will just get into those rounds, and those will close before you even know it. Right. So those top quality deals, which are likely to be the ones that will give you that outperformance, are not accessible. And the trick is to figure out how to access them, and that's what we've solved at Infinyte Club. Right.
Joy, do you want to add to that?
I wanted to add just this underscore this point about access and then having a portfolio approach to this, right? It's you can't allocate a lot of your capital also to such a risky asset class. So you have to also consider what your risk appetite is. Do you have the stomach for it? Do you have the muscle for it? Right, both of them are equally important in this game. And I think the other is just access. You have to have the best access, and you need to know where the hot deals are and what's actually happening, and also have a point of view. It's not just about adding to any company that just comes your way, right? Also having a point of view and saying, why is it that I would invest in this, and why should a founder also take my capital? I think both sides of these are important, because otherwise it's very easy to lose steam, and it's easy to lose conviction. It's easy to come and say, oh, where is my liquidity on this? It's like Anki said, it's just not an asset class for everyone. It takes about 7 to 10 years at least for a company to go public, or even to see a liquidity event. Now it takes even longer, right? So then, do you have the stomach and the muscle to stay in the game for that long? Are you going to give up when things go up and down? Because startups are not easy, whether it's building them from the inside or watching it from the outside, right? It's a hard, crazy roller coaster journey. So on either side, are you going to be able to stay equanimous and stay in the game? I think that's the most important question.
Yeah, I think you've touched upon very important points. I think taking the portfolio approach is super, super important. I know several people, because I run my own syndicate on AngelList, I've often seen this behavior where people will get very bullish on one particular deal and sometimes over index on that particular deal, and sometimes invest much higher than they would usually want to. And, one aspect is excitement about being in the deal, but it's also about having the right access, right? Because it can take a while for you to even get to know whether you have access or not. What can look like access, just because these platforms have made it easy for you to invest, doesn't mean that you have the right access to that right deal, right? Or this deal is going to be an outlier. In fact, I met a young 21-year-old who has taken this portfolio approach so seriously. He's invested a lakh each in 20 plus different companies, right? So one has to think about these kind of aspects, where he has no public markets holding. But a lot of the times when we read about super angels or even large family offices investing, only private market investing is actually sub 10% or sub 15% of their entire portfolio. And I feel a lot of young people in the ecosystem are getting carried away and are so bullish on the private side that they're not doing public markets investing at all, right? Or doing or allocating a very small chunk of their portfolio towards that. So, can you just talk about this portfolio approach a little bit more, zooming out, not just private market investing, but how should one think about designing their own portfolio at a construction level?
Got it. Um,
Yeah,
let's get a little nerdy about this, right? I think the holy grail of portfolio investing was set out by
yeah,
Markowitz. I don't know how many years ago, right? So it's called Markowitz's modern portfolio theory, which essentially talks about building a portfolio, a well diversified portfolio with non correlated assets. So what that means is across your own utility function,
yeah,
across your needs, what your goals are, basis that you should set up or invest in asset classes which are non-correlated with each other, so that over the long term you are incrementally growing your wealth, right? um, Markowitz's theory, obviously is basis, the assumption that human beings are rational, and we all know
yeah,
that human beings are not rational, right? So I think there was another theory put forward, which is called the prospect theory by Kahneman, which essentially brings in the element of behavioral economics, of how, that, and putting forth the thought that, human beings are not rational. So in an ideal world, Markowitz is great, but human beings are not rational. It's essentially talks about human beings will together, invest in insurance, but at the same time buy lottery tickets, right? They want the both extremes of the of the spectrum to kind of fire for them together. So I think, taking from, a step further from that, okay, we think that there is a three basket approach that, you should have, right? One is your market, your personal risk, right, which essentially means that is your roti kapda makan covered, right? Do you have enough money built up so that you'll never be on the road, if for a lack of a better, explanation of this, right? You have to have your emergency fund in place. Are you ever going to get ruined because of a,
yeah,
black swan event, right? So your personal risk needs to be covered, right? So for the 21-year-old that you spoke to, make sure that, if you ever run into him again, make sure that he's got his personal
yeah,
risk basket covered. The second basket we kind of look at is your market risk, right? Like, which essentially means that is, the money that you're building up, or to sort of grow your wealth incrementally over a period of time, right? Like incremental growth, so that sustainably are you growing. This is what you will call your equity market, SIPs, etc.
yeah,
Are you building this up, right? And the third basket, which you spoke about, right, is what we call aspirational risk, right? You added this perfectly, right? Like every day in the newspaper, we are reading that, this founder has raised this much money, or this angel investor has made this much money, and we're the chatter around the startup ecosystem is so loud that that it is all pervasive, and
yeah,
everybody wants to be a part of it, right? So the way to think about it is that, and also the Instagram generation, you're seeing all your friends, traveling here, traveling there. So people are not satisfied with just, an incremental growth. They want to jump and orbit shift into the next layer of wealth. So this basket is what we call taking aspirational risk, is what will enable you to get there, right? So this basket is where you take highly concentrated, highly risky bets, which obviously there is this, chance of, not going right, but it kind of gives you that optionality or the chance to jump orbits into the next sort of tier of growth or level of wealth, if I may say so. So now, what should be allocated across each basket, only people's personal circumstance can define it. There are people who are incredibly wealthy who will not have a middle basket at all, right? They will only have a barbell approach to investing, which means that they will have just the, amount that will cover their personal risk. But on the other hand, they're only playing super risky games, where or super risky investments, which will, enable them to multifold their wealth, right? But these three baskets of having your wealth allocated across is probably the most sustainable way of accessing different risk profile of
yeah,
asset classes.
absolutely. Joy, do you want to add to that?
No, I think just underlining another point that Anki made, right? We are not rational beings. We're extremely emotional beings. So, which means at any point we actually end up taking an emotional decision about investing. I think we have to take a step back and say, what is the rationality here, right? Or what is the rationale that's even driving us to do this? So many of the times we see, I think, people doing this. It's startup investing just because of the thrill of it, and it's not meant for everyone. It's so volatile, it's so illiquid. Like, you got to take a step back and say, why am I doing this? And most of us are already concentrated in either our ESOP holdings, or as founders we're in our own companies. So I think, we have to make sure we're mindful of that, and then figure out how do you allocate across these three baskets that Anki spoke about. I think that's just so essential. Like, we're not rational, so then what are we doing in the heat of the moment? I think something for us to consider.
Absolutely. I think my rule for startup investing is that it should not make you lose sleep over it, right? If it makes you lose sleep over it, then you're probably over indexing on an asset class, and then you probably shouldn't be doing it. You can look at safer assets, which are very healthy and long term, that you can stay invested in, and also have liquidity at your end, because a lot of young people don't appreciate having liquidity in bad times because we haven't gone through enough cycles yet, right? But coming to ESOPs, since you touched upon it, Joy, I would say that ESOPs as a concept is still not very deeply understood in India, because as a country, we've always placed a premium on base or enhanced salary versus thinking from the ownership mindset. However, this is changing rapidly with success stories from folks who were early at companies like Flipkart, Paytm, Zomato, and have created significant wealth for themselves. And Infinite's success is also very closely tied to the growth of this pool of people who have the owner mindset versus being an employee. What do you think will be the evolution of this space over the next 5 to 10 years? And what will be the key inflection point for Infinite's growth?
I think I want to take us back to the US, right, and how the US market has evolved. So many of the investors we see today, and solo capitalists, these are just people who write really large checks and are angel investors on their own monies, and other people's money. Are How did they get started? Right, they were employees at some of these larger companies. They had ESOPs, which means they had ownership, which eventually became liquid, and they've then gone on to become angel investors, etc. I think the key part of this, and like you pointed out rightly, Srishti, is ownership. Right, having ownership is so essential to this. And I think what we will at least hopefully see in our market, therefore, is also this solo rise of the solo capitalist. I think a lot more people wanting to write larger checks, wanting to own significant equity in their own companies and other companies. And when I say their own companies, it also means the rise of entrepreneurship. When we started out, actually, we spoke to about 100, 150 people, and we asked some of them who had gotten liquidity, what did you do with it? I think the first 10, 15, 20 lakhs, it was like paying off loans, you're going on vacations, you're buying your vehicles, you're buying cars, whatever suits your fancy, right? After a certain point, what people are doing is actually putting this money aside to start up, and whatever the business may be, right? Like, just giving fuel to their dreams. And I think that is the power of what ownership does. India has traditionally been all about small businesses, etc., but the relationship has been very often just a promoter and an employee mindset relationship, right? But I think we're seeing that change with the tech and startup ecosystem. We're seeing people becoming owners, people asking questions about their ESOPs, asking for more ESOPs, more ownership, and then obviously the rise of these mafias, right? That you pointed out, Paytm, Uber, name it, and people have gone on to start their own companies. They're funding each other's companies, all of that, which is just beautiful because one, it creates entrepreneurship, which is just a virtuous cycle in itself. It unlocks people's potential, just like they're giving fuel to their dreams, seeing more of their own dreams come alive, and then creating just jobs and just so much more liquidity, and then therefore consumption in the market, so which is, I think, great. Anki, do you want to add anything here?
Yeah, no, I think you hit the nail on the head, right? I think that there are these mafias that are emerging out of these companies, which is setting in motion a virtuous cycle of, innovation, employment and wealth creation, right? In the Freshworks IPO, there were 500 crore pati that were created, and 70% of them were below the age of 30. Imagine having, being a crorepati before the age of 30. Flipkart did, their liquidity, and there were 19,000 employees, I believe, if who got, a part of the, 700 million or 900 million, whatever that number was. So it is absolutely amazing what is happening. And I think, to your point, the inflection point of what will make Infinite successful is here, right? I think we believe that this chain reaction has just gotten started, and here we are here to serve exactly this consumer, exactly this investor who is working in innovative companies, leapfrogging very quickly in different layers of sort of or different sort of categories of wealthy, and they need a new solution, and they need a new tool to help them manage their money and invest their
Yeah,
money.
and
So
also
we're here for that.
let's talk about how much ESOP value Indians really hold, right? Because I heard you mention this number, which was very surprising to me. But I think it will really benefit our audience to learn about this number, and also how people are exploring different avenues through secondaries and selling their ESOPs by and are able to monetize their ESOPs. Because a lot of people might not have tasted it, and when they're negotiating their salaries or having those discussions with HR in terms of how much I want in stock options versus in hand, I think people can really benefit from these insights, because it'll help them think from that ownership mindset versus employee.
No, absolutely. I think there are about 114 unicorns in the country today, as far as I think I've had getting the number right. So, and let's say an average valuation of these unicorns is about 2 billion per unicorn. So it's $250 billion of market cap on just the unicorns in India, just unicorns alone, right? So the ESOP pools are typically 8 to 10%. So you let's say that there is a $25 billion ESOP pool sitting in just the unicorns. And let's count all the other companies that are unicorns and on different sort of stages of Series A, Series B. You're probably sitting on a $30 billion ESOP pool in India alone,
Right.
right? So I think that is the latent potential will waiting to be unleashed. So I think people have to imagine when that starts to start getting liquid and start coming
Yeah.
into people's hands, right? It's incredible. These numbers are just
Yeah,
absolutely
and
mind
I
blowing.
think, people are often surprised that, sometimes when there are projections out there that India will grow from a 4 trillion to a $40 trillion economy, people are not able to wrap their heads around how this growth will happen. But I am actually very bullish on the private sector to drive a lot of this growth, because that is how we will truly leapfrog, right? So let's also talk about where India is in the macro cycle of things, where, obviously we've experienced a massive bull cycle right now, where some people are sitting on 30-40% IRRs in their personal portfolio, and they think that this is sustainable, right? But unfortunately, markets operate in cycles, and there is a bearish phase that will follow the bullish cycle. So how should one think about the market cycles broadly when they're designing their personal portfolio?
No, 100%. I think it's absolutely foolish to believe that a 40% IRR is sustainable. It's not. So people who may have just about started investing in the last 1.5, 2 years
Yeah.
would probably see that number in their portfolio, right? But I think the longer you sort of invest, that number becomes a lot more stable and rational. I think in the long term, in a country like India, 14 to 15%
Yeah.
IRR is fantastic, right? So I think the answer, but I think what's also interesting to point out is that in the age of the internet and information, there is absolute perfect, sort of information exchange that takes place. Market cycles have shrunk. So historically, a business cycle or a market cycle would be around 7 to 8 years. We're seeing these markets cycles shorten to 2 and 3 years, right? And so that, of course, inherently means that there's a lot more volatility. The only way to protect against volatility is to have an asset allocation. Do not be overtly concentrated. In any one particular asset class, because then you will probably there will be a day, not if, but
Yeah.
it's a question of when. There will be days where, or sort of a period of time where your portfolio will be absolutely hammered, and it will cause you sleepless nights. So it is important to be well diversified. It is important to have a cogent thought around how you're constructing your portfolio. And the last thing I want to add is that I think India has an insane amount of what is called as human capital in economic terms, right? Like, what is human capital? Human capital is your ability to earn. So I think, what is our median age now? Median age of
29,
the
I
country is
think.
28,
Yeah.
29, I think, if I'm not mistaken. Yeah. So that means that the most people still have about 40 years, is that right? Yeah, I think, let's say 35 years of working life still left, right? And that's the maximum earning potential for the median India is still there. So we have a huge amount of human capital, which is likely to drive this economy, which is why how we're going to get to this 40 trillion number that you spoke of. I read an insane statistic this morning. There are 43 mutual fund houses
Yeah.
in India, and their assets under management as at the end of August 2024 is $430 billion. And the crazier part is that it has grown by 50% from
Yeah.
last year, right? So what we're seeing across the board is a systemic shift in terms of the risk that every individual is willing to take. Historically, Indians would park their money in their savings account, or if one step up, would some people put their money in FD. From FD, now it's moving to deploying towards markets, and people who are deploying towards market are deploying towards private markets. So that at every stage there is a systemic shift and an increased appetite for risk
Yeah.
that the country is seeing, which we think is fantastic and very,
Yeah,
very
I think
exciting.
financialization of savings is a big theme which is happening across the country, and we are seeing that in the booming SIP market. I think 23,000 crores is the number that is going in terms of monthly inflows, which I couldn't have imagined just 10 years ago. But Joy, you were at Sequoia India before, now Peak 15. You've worked with some of the smartest product minds of our country and globally. It definitely reflects in the product you have built because it's so seamless and almost magical to use despite the complex nature of a transaction being executed. Everything from compliance, legal, paperwork, and so much more goes on behind the scenes. What were some of the foundational levels that you wanted to get right when you started building out the product?
What a good question. And you know how lucky I was to have that experience, right? Of just working with some of the best founders, product managers, engineers across the world, actually, like India, Southeast Asia, the US. I think it has informed how we've approached product building for this class of intelligent investors. I think one is, look, people like us are constantly using really great products on the app, on our mobile phones, right? Like apps, just like quick commerce, e-commerce, name it, like it comes in 10 minutes. It's such a smooth, seamless experience. Like look at the UPI rails, right? Just works so beautifully. I think one thing that, at least coming into this, one thing I realized was it was just not as fun to use any of the wealth management products. Most wealth management products had a very condescending take. Either they were just so basic that they just gave me some numbers and I had no clue of what to do with. There was no insight or intuition associated with it. That's one, right? And the second is a very condescending take, almost like that same wealth manager sitting there and saying, "Oh, you don't know anything. Here's what you should do," but in the form of an app. I think that wanted to break away from that. The third was, I think, just most of us have such a negative relationship with money. We're afraid of it, we're scared of it, we're terrified of it, we feel we don't understand it. And I think my counter question to that is, most of us work in really demanding jobs. If we can do what we do, I don't see why we can't do that with our money. We have the skill set to understand complex problems, to understand what's happening, how things move, and why can't we apply the same intention even to our money? So how do we kind of break that barrier? I think the most important principle, at least from that perspective for us, was how do we bring positivity into this? How do we help you have trust and assurance about your money, your transaction, right? It was very, very important. I think every day it's always like, we're not going to make people feel afraid of what is happening. We're not going to make people feel like less than, or any negativity about their relationship with money. It's just not going to happen. And then it was also just this idea that, I think you spoke about this earlier, Srishti, that so many of us have our ESOPs, our wealth tied away in ESOPs. And how do we kind of help you think about what this human capital and how you're investing your time, how you're building out your career a lot more holistically, right? Because a lot of the times that is the input funnel into what actually becomes our wealth. So, how do we help you think about this a lot more holistically? How do we help you see what others like you are doing? Which means it became a lot more social and multiplayer, right? So, our product, if you look at it, it's actually multi layered. What we saw was most products tend to be transactional, saying, okay, come in, do XYZ, and then just go away. But most of us are actually, we have an emotional psychological side to how we deal with money. Think about how you book a airline ticket, right? Like, especially if you're going traveling internationally, you're going to say, I'm going to sit on this over the weekend, I'm going to open my laptop, I'm going to check my dates, I'm going to double check, because it's an expensive, difficult transaction, and we didn't want to have that experience with your money and your wealth, right? It has to be much more seamless. It has to be a lot more easygoing. It has to be an engagement on the daily, which is to say, okay, how's my money doing? What's happening with it? So you'll actually see all of our products are geared towards this. We've got a newly launched mutual fund tracker, which is meant to help you with intuition and insight. So when you have a conversation, and this was very foundational to us, right? We said, when you have a conversation with your friends, when you have a conversation with your financial advisors, when you have a point of view on the market, you should be informed no matter what. How can we give you insights? How can we give you information? How can we give you tools to just be more informed and be on top of it? So I think that's actually how we've built out the product. And then when it comes to the nitty gritties of just like a transaction, I think that is a non-negotiable on making sure it's easy, it's fast, it's seamless, it's safe, it's secure. This is people's money, hard-earned money. We have to treat it with the utmost respect and sanctity. So which means everything gets documented. We're over communicating at every step of the way. You're always in the know of what actually is happening, what's going to happen next. And we've actually built out the product and the workflow in such a way that you can actually finish your investing journey in 3 steps. And if you've got all your documents together, it should take you 48 hours. Actually, that's the goal, right? On a good day, it takes us a week, because getting all our investors in place, getting all the paperwork done. But if everything of all of that is sorted, 48 hours, you should be ready to go. And especially if you're a founder raising, you want that money in your bank quickly so you can get to building, which is actually what you should be doing. So yeah, I think those are just how we've thought about it. I think just making sure people are feeling positive, people are always informed, and we're helping you build a better relationship with your money.
Those are some very interesting insights into human behavior as you talk about product development, because I think building great products actually requires a good understanding of how human behavior is at large as well. But, what is interesting is that you actually have been able to build magic into the product. I have never used a product which is so seamless. You're doing such a complex transaction, but on the surface of it, it's looking like it's literally just taking money from some place and you're parking it somewhere else, right? But if you give people the context of what used to happen before to be able to execute deals, I think it'll become more even better to understand that it was actually very complex. And soon platforms like Infinite will make those seem like lessons for history books, because now that'll become completely outdated. But just for our viewers understanding, can you give some context on how the world actually was before Infinite came about?
It's a great question. I think, Shrishti, before I answer your question, I'm going to just say that I think Joy's genius lies in the fact that not only is she able to simplify workflows, right? Like, of course, your workflows need to be simplified for a good product, but how do you layer on an element of psychology onto product as you build it out? I think, like you said, that human beings are overtly emotional. There is a very large aspect of feelings that go into building a product. So I think Joy is a master feeling infuser into a very complex workflow. Now, to get to your question about what was the context prior, so I'll tell you from the founder's perspective, right? So when we got started, we were fortunate to have about 40 unicorn founders who invested in Infinite, as we got started. So we figured that okay, let's get the transaction going, but we didn't know how complex the transaction is going to be. So honestly, from end to end, from the time we started to the time we actually got finished, it took us about close to 6 months to get everybody's monies in, to get everybody's paperwork done. And honestly, it was such a underwhelming experience, both as a founder and both, I'm sure, as the angel investor, right? So these folks are like, really busy people, and like, and here I am pinging them and, oh, send me your PAN card, send me your Aadhaar card, self-attest it, give me your bank account, give me this, give me that. Now wire the money. Here's the bank account. It was just
Yeah.
god awful. It was a horrible experience. And then for the founder side, it was just like, we should be spending our time building the company, and not spending 6 months to collect or to get our seed capital going, right? So I think that sort of really made us pause and rethink and said, okay, is this a problem that really that needs to be solved? And then we realized that this is the problem for probably all angel investing. If we made this easier, would it make it a lot more easy for people to transact, or to get into this asset class? We actually had a foreign, a US based investor who said, actually, you know what, for lesser than $5 million, I don't want to do an angel check in India, because the paperwork and the compliances, associate compliances, are just so
Yeah.
much that it's not worth my time. So that's the context that we were living in. And I think Joy has an insane story on this one. So we had Joy, you want to jump in over here on the story of that, the one investor we could not manage to get hold of?
Yeah, like it, and I want to say this, right? That when we got started, like by the time 6 months were down, I was like, okay, I'm going to get a sector. I'm going to start building because this is just taking up too much of our time. So Anki was spending all of her time chasing down investors, and we had this, project tracker which said, okay, this person, where are they on this funnel? Have they sent documents? Have they wired money? Have we sent follow up email? Have we sent thank you email? Like all of this, right? Like this was a full workflow. Took us 6 months. And then we split up this list and said, okay, we're going to chase down a few investors, together. And at one point, I think this was an investor based out of the US. Almost all of his paperwork was here, but I think PAN card was missing. And he's busy. He's running a really large company right now in the US. So in the midst of, I'm sure, important things that are happening, and here we are saying, hey, hi, can you give me your PAN card, right? And it just obviously not P0 for him, but P0 turns out for us. So at one point, I went on to Twitter. I was just not able to get his attention, and I liked every single one of his tweets. Just one after the other, just went at it. I was like, okay, how do I get his attention? I have no clue how to. Like, short of sending smoke signals out. And he pings me and says, are you okay? What are you doing? And I was like, I need your PAN card. I'm really sorry. But I just couldn't figure out how to get your attention. And this is just like, it's a wild story. This is wild that it happened. But some part of this and some nature of this is always happening, right? Like we'll have to chase down somebody, we have to just make it's just so much work. It's just, and on both sides. And why must that be the case? Right? Today, like think of how you do a UPI transaction. You scan a QR code, money is moving. Right? And here we are. It's one of the most innovative assets that you're going to invest into. Startups who are just working on cutting edge stuff. And turns out the process of getting this done is archaic. It's like, hi, I'm going to send you a paper and I'm going to send you a pigeon with a, like, and a paper plane or the, after that. Like, what's going on? Right? And why is this not happening on a mobile app? Like, why, like everything is in our pockets. Like we're making payments, we're like, having doctor consultations, and then somehow this asset class, which is supposed to be the coolest asset class, which is supposed to be so sexy, has all of the smartest people on it, has like the most archaic infrastructure on it, like which is just bizarre, dissonant, incongruent. Shouldn't be the case. Let's get into 2024, guys. Like it's just like let's get a move on this. So that's actually what happened and how we got started with this. And I just want to add one more thing, and I think you spoke about the magical element to it, which is a value we actually borrowed from Uber, who said make every interaction just delightful and magical. I think the take here is, and just with angel investing, it's about you're excited about something, you're looking forward to something. So then why must this be painful and annoying? And is there a way to infuse a little joy into every little moment and transaction, right? So I think that's how we came upon this workflow as well, of saying let's keep you safe, assured, but also delight you a little bit.
That's amazing because you are doing such a complex transaction, but you don't feel like it. You feel joyful that you are doing it. So what else could you want from your customers, right? That is a true sense of product market fit as well. By you have established with your customers already, because there is so much trust that Infinite has been able to build without being out there in the market for too long. It's incredible that you have executed 60 deals and have $10 million in terms of invested value on the platform, but it's not an easy feat to have accomplished in such a condensed timeline. So let's also talk about what goes into establishing trust on a new platform, right? There are so many new platforms which are emerging for alternate investments, and then when we look at the broader landscape, obviously where each platform differs in terms of what is the security they're offering on the platform, that differs. But even though startups are such a risky and illiquid asset class, you've been able to establish trust in a very short period of time. So what were some of those learnings that went into building this product that you were able to do that so quickly?
So I think, Shrishti, you're absolutely right. I think there is you have to. I think when it comes to financial services or any kind of fintech product, trust is paramount, right? So I think that's something that we recognized very very early on. So a couple of things. We Joy and I recruited our first 1,000 customers ourselves, right? Like I think we've probably spoken to every single customer, and that in the first the first 1,000 folks that joined the platform. We were also very fortunate to have been in the ecosystem for a long time, and of the 40 unicorn founders that backed us, a lot of them became our early customers and design partners. So we very deliberately choreographed our early cohort of investors to be the people who are flag bearers and torch holders of this particular asset class, and people who you actually should be following for advice and direction if you have to jump into this asset class, right? So that was something that was very deliberate. uh, from that perspective, we are very grateful for our former experiences and the network that we've built out, because it is that network or the work of the last 17 years that we both have that has enabled us to be able
Yeah.
to actually launch this product, right? The second thing is that I think we talked about this in terms of our product, or the way we think about product, is that every interaction, while it also has to be magical, it also has to be trust giving, reassuring, right? I think there was a very one fintech founder had given us this advice very long back, that in fintech, over communication
Yeah.
is essential, right? The more you communicate about the status of their money, the status of the transaction, on what's going on, it's not going to be treated, or people are not going to feel it as spam. People are going to feel actually good about it. So I think some of these principles that we have been very very thoughtful and deliberate about, and we've ensured that every interaction that a person has with us, or with the product or with us, is trust giving.
Joy, do you want to add your
Yeah, to
element of
add the
psychology to it?
yeah, I think no, but I think the other thing is just also just getting rid of jargon, right? So much of our workflows, so much of the money conversations always filled with jargon. It's instead of saying how do we simplify and just tell you exactly what is going on. I think, and that's a principle of transparency. I think something we always hold. We're dealing with intelligent people. We're going to meet them exactly where they are as they are. We're going to tell you exactly what's going on. We're going to tell you why we're doing something. We're going to tell you everything that you need to know about a particular opportunity that's come your way or a particular investment you've done. We're going to give you all of this data, right? I mean, just that was the other a very important aspect of it. And I think the other thing which we are very very particular about is every asset that comes onto our product, we have to vet it, and we have to make sure that we're actually offering the best product to our user base, right? Which is because, I mean, you could have gone anywhere and you're here, and it's only fair that we treat you with that respect and give you the best products, right? It's not like We'll bring out any deal anytime unless we've vetted it. We've gone through all of the paperwork. It's painful, painstaking, but it's just worth it. Which means, like, even as founders come in with their opportunities to list on our product, we work with them to go through every line item, and we go back and say, hey, we've had one case where I think in some the share percentages didn't add up to 100%. They were more than 100%. Right? We went back and said, hey guys, looks like something's off over here. Right? Looks like your share allocation is not adding up. And these are little things, but it's very important to us. Every little, like, even as we talk about the highlights of a particular opportunity, we're making sure as an investor you have everything that you need to know, everything you need. It's your money, it's hard-earned money. We have to treat it with the utmost respect. So I think this is just how we've operated. We continue to operate in that same fashion. If we'll communicate via all channels that we have available to a user, right? Whether it is a push notification, it's an email, it's a WhatsApp, it's a call. Like, we're always there. We'll respond. If Anki and I have to jump on a call, we will make sure we do that. Like, we make sure no customer query goes unanswered, and we run we have these Monday morning syncs on saying customer feedback that has come over the weekend, so that it's addressed immediately. It's like P0. Okay, looks like we missed a communication line. How do we better that today? It's not like it's going to be pushed out for 2 weeks later, but it's just how we do things. Because how you show up for something is how you show up for everything, right? And I think that's just so core to who we are and how that translates into our product and how we do
Yeah,
business.
and I can personally vouch for that as well. I think my first onboarding call was with Ankita and Joy. You were there as well, actually. So, and then you've been true handholders in that sense, where every deal where someone is participating, you were able to walk them through it. Which obviously that's not a behavior that can scale, but it really helps in establishing trust as soon as you start, right? In my view, you're building a platform with a strong distribution network of solid operators from some of the best companies of India. Your users are probably the brightest and most talented lot of the ecosystem. You identified a strong user persona with a high propensity to transact, and the fact that their needs were not being met by traditional wealth management platforms. How do you plan to scale your offerings to meet the needs of your user base? Because, from this private market investing, there are so many opportunities in wealth tech. How do you look at that opportunity broadly?
That's a great question, Shrishti. I think if you look at the India stack right now, the India has about 7 million people that are working in tech, finance, and sort of tech adjacent startups, etc. Right. So this is the emergent cohort that we believe that or that we want to serve. Right. This is the cohort that we call the intelligent investor. So we got started with the asset class that we believed that these folks would care about the most. Right. Either people who are slightly ahead in their journey, who have already made their money, they want to invest. People who are just got started on their journey, they've got ESOPs, etc. They're looking for liquidity. So we found as private markets, or ESOPs as an asset, is a great place to get started to serve the entire sort of ladder of investors who are building for modern India, right? As we kind of build, and we spoke about three sort of risk buckets, right? Like personal risk, market risk, and aspirational risk. So within this stack itself, so for people who are sort of early career, they should be looking at solving for their personal risk, and their market risk. People who are later on or further up in their career should be looking to solve for their aspirational risk. So for each stage or sort of career growth that people are in, we're going to be building in products, or we're going to be stacking up products along
Yeah,
that
of
ladder.
course.
Does
And
that make sense?
do you want to give a glimpse to our audience of what you have in mind?
Get in finite, join the product. I think we've gotten into a pace where we are releasing really quickly, and there are a lot of new interesting things coming. We'd rather have people experience
Yeah,
this
but
than talk about it.
increasingly, I'm seeing a lot more deal momentum on the platform. You recently launched a pre-IPO of offering as well. We won't take names here because all these things are pretty confidential if in nature.
Yeah,
But
yeah,
talk to us about the pre-IPO offerings as well, right? Because right now, what's happening in the SME IPO market and also the IPO market in general, I think there's a lot of froth and frenzy around securities getting
yeah,
listed because there's a lot more demand than the number of investable assets which are out there. So how are you
yeah.
thinking about this pre-IPO opportunity if you want to highlight some aspects around that?
Great question. I think, Shrishti, I think again, I want to underscore that even private markets are not for everyone, right? Or even pre-IPO is not for everyone. It's sort of the last stage before a company goes IPO, right? So there is still a significant amount of liquidity risk. I'll give my personal anecdote, right? I actually bought a company, a pre-IPO share of a company. I'm going to say 6 or 7 years ago. It is a subsidiary of one of the largest banks of India. At the time, there was the chatter around it or the news around it was that it's going to go IPO anytime. But it's been 7 years and it's not yet gone IPO, right? 6 years, something like that. So you have to. So there is a lot of liquidity risk. There is a lot of a lot of uncertainty around this asset class as well. So I think the one you know caution that I want to throw to everyone is please do not invest into asset classes that you don't understand. FOMO is literally the worst way of investing your money and the fastest way to lose your money, right? So I think that is absolutely essential. There is a lot of, you're right, there is a lot of excitement and in the market. I think people are um, leaning on one another to see what others, their friends, are doing. That's not a good way. Please understand the asset class you're investing in, do your own research, and only get into something that you truly
I don't
understand.
know how it was for you on the app, but I'm seeing some of the SME IPOs and other IPOs get oversubscribed by 50 to 100 times. What kind of demand did your pre IPO offering see on the platform? Was it as brutal as that?
It's brutal because I think to give you a sense, I think the demand that we had was 20x of the
Wow.
supply that we had, right? So I think that is something that obviously it's encouraging that on one hand, but it's also that oh my god, that like how do we figure out to how do we serve this demand in a cogent manner,
And
right?
one often wonders because obviously there's limited allocation for each deal that you can possibly get. So, just from a dynamics perspective of what's happening at the back end, how are you negotiating with the companies or how are you negotiating with the founders on what allocation to bring to the platform? How do these deals get structured on your back end so that the audience can have a better understanding of the backhand behind the scenes story at Infinite?
Got it. I think Shrishti, you we spoke about this earlier, right? I think for a startup to succeed, or rather your startup portfolio to succeed from an investor's perspective, you need to have access to the best quality deals. Let me qualify what the best quality deals are. The best quality deals typically are with founders who are seasoned, founders who have the backing of top tier investors, because those top tier investors will enable you to kind of get access or unlock the next level of growth for you. So access to the right quality deal is also paramount. Now these right quality deals are so hotly contested and they are so fiercely fought for, right? I think you can speak more than me, because you've also seen, I think, I'm sure, allocation, fights for allocation. So typically when we so one is number one is getting the right
Yeah.
type of company. Okay. Second is the allocation. Typically, you're fighting with like names like like the top VCs, top super founders. So you're able. So allocation is something that you get. Now that is fixed and firm. So that comes to us now. From the investor perspective, I think you have to, one thing again, I'm going to say this again and again: please don't invest into something because of FOMO. Invest into a company only because you like what they're building, you actually understand it, and you deeply believe the market they're trying to serve is going to exist, or the product they're trying to build is going to be useful 5 years or 10 years from now. And then we sort of then you can sort of commit to the transaction, and then usually we are in a place that that our deals are so hotly demanded by our investors. We have to kind of lean on first
Yeah.
come first serve basis. uh, so that's the way we kind of sort of tier, or that's how the journey of the transaction
That's
typically
very
tends to flow.
interesting because some of my hottest deals that I've taken live, sometimes get subscribed in 20-25 minutes. And then, you are left with disappointed LPs who wanted to participate but couldn't. So, one part of it is also managing all those relationships and the expectations of people who are investing on the platform. And on this same thing, let's talk about, one of my favorite authors in personal finance is Morgan Housel, who's written Psychology of Money and Same as Ever. When you read those books, you realize how everyone's relationship with money is so unique to their individual experiences. What are some user insights or behaviors that have surprised you over the last 2 years? Joy, I want you to lead on this one.
Yeah, I think something that's come up, and we've seen this on our product, is I think we've got a lot of our operators and they have a thesis led approach, right? We've seen that happen both ways. We've seen founders who have said, "Hey, I'd love to have some of the best product managers, the best engineers, the best designers, data scientists on my cap table. I don't want passive capital. I actually want active capital." Right? So I think that is one interesting trend we're seeing. And on the other hand, we've seen thesis led, right? Which means operators have a point of view. They're working in this space and they say, "Hey, we want to see more SaaS companies emerge. We want to understand their GTM. We want to see more gaming companies. We want to, because these are sectors that people are passionate about. And the other interesting thing here that we are seeing is people want to invest in sectors in which they also consume very actively, right? Because if you are a customer, you also want to be an investor. And I think it's a great thing, right? Because if what better thing for a founder, because you've got like now a passionate person who loves your product and is also going to champion your product, like nothing like that equation. So I think that's a trend we're seeing very interestingly emerge in India, and we've seen that I think happen in the US as well as it's happening here. I think the other thing is people don't want to invest in vanilla products. Don't give me the same old stuff, just with a new bow on top of it, right? Like we are at the top of our game in our work, right? We're always ahead. We're always reading up. We're on Reddit and we're on Hacker News and we're on TechCrunch and Your Story and everywhere else, consuming content. We know what's happening, and then I think most of us feel very condescended to when we're told, okay, you know what, here's another cookie cutter financial product for you. So I think that's another thing we're seeing on our product as well. People don't want to see the same old stuff. It's like, tell me what's new. And this is also interestingly, I think, something that most wealth managers tell us, right? That their customer base always wants to come back and say, hey, kuch naya batao, like what's happening, right? Tell me what's new. People want to be at the cutting edge of their areas of interest. So why offer them the same thing over and over again? So I think this is some of these what we are seeing. And then we're obviously in private equity and VC itself, we're also constantly pushing the bar and saying, how do we innovate? How do we bring more access? So we've had our regular angel investing deals, we've had founder-led vehicles, and we also launched Moneyball, right? Which was to say, how do we bring in a portfolio approach to startup investing, which is where most of us, like Anki has repeatedly said, we don't have access, and at the same time you need to build up a portfolio. So again, these are just innovative ways and innovative ways of investing, and also at smarter ticket sizes. So you're not just putting all your eggs in one basket, but you're building up a portfolio, spreading your bets. Yeah, I think, and we'll see more of that coming, and we've got a few more products in the pipeline, so we'll see more of that coming on the product as well.
Ankita, any user insights that or behaviors that surprised you on the platform?
And I think you called out Morgan Housel's book, right? I think when we got started towards building, we said that it'll be such a win if we're able to productize this
Yeah.
book, right? So that was actually when it's great you say this, because it's absolutely a must read for everyone at every stage of their lives, whether you understand finances and money deeply. It really kind of shines a bright light towards human psychology. It's written in such a simple manner, right, that it enables even people who are just about getting out of college to really build a positive relationship with money and build an absolutely cogent way of growing your wealth. I think in terms of user behavior on the product, I think what you know. I think what surprised both Joy and myself was, I think intuitively we knew that this is the asset class to sort of get started with. Uh, but I think just the magnitude of it and the speed of it is what I think perhaps took us a little bit by surprise. That that wow, that this is how fast we could you know uh, attract this ICP that we want to go after. I think that was really surprising to us. One very interesting it's an it comes to mind immediately is I think just yesterday, we actually launched our mutual fund tracker. 10 days ago, if I'm going to be, yeah, about 10 days ago. And we had someone write into us and say, you know what, my money manager was shocked at how well I was prepared for that call because of the insights that I got from your product. And that for us was such a win that this is exactly what we wanted to do. Because what we are, our core insight was that people want a sense of learning, accomplishment, and control when it comes towards their money, right? They don't want to be condescended to, they don't want to be told, they don't want these wealth managers who are self-appointed life coaches and say, I will tell you what to do with your money. No, bro, I know what I want to do with my money. Just arm me with the right information. So I think that's always been our sort of driving motivation, and we were super excited to see that really come through and land with our investors. Joy, do you want to add over here? Have
No,
I
I
missed
think that
something?
that was a fun story, because I think I was telling Srishti earlier, right, that we've always wanted to have where you can have a good conversation with your peers and friends, with your money managers, and have a point of view on the market, and it just landed. And I think that's the sweet spot, right? Constantly, or somebody would ping us and say, "Oh, I did not think this about this opportunity or this deal." And it's just when we launched, I think, Moneyball, we were subscribed in 6 minutes. Like, we were gone, we're done, we could close and go home. 6 minutes, 6 minutes, like, it's insane. Right. And then we were just clocking, like, we're saying, okay, where is this going? So yeah, I think there's the appetite is huge. There's hunger, there's ambition, and all that's actually missing is just insights, information, intuition. And if we can cover that, we know we're golden.
That's when you know you've truly hit product market fit, right? You literally feel it in your bones, because you couldn't have imagined the kind of reception there is for your product. There's immense customer pull. And now that you've reached that product market fit milestone, how are you thinking about building the business differently?
You know,
Has anything changed for you?
Before we get to that, we'll add one more detail. I think you have hit PMF when customers are pissed at you. Okay, I think we have a counter view on this. It's like when customers are
Yeah.
saying, "How did I not see this? How did I miss out on this?" Like, and then we're going back and saying, "Did this person really miss?" No, it was just timing. It was like few seconds or few minutes. It just Customers are just banging down our door saying, "Why didn't you tell me about this?" It's just that's product market fit, right? Because
Yeah.
people are giving a shit about what's happening in their lives. It's what's happening about their money. They care, and that's it. Like, actually, that's what we need. So I think from that leading into how we're thinking about what next is just the intelligent investor is at the heart and core of what we do. And it's interesting and it's good for us that I think we're in this cohort of similar people, right? Like startup operators. We're always saying it's interesting because the dynamic between Ankita and me, she's the money manager, I'm the user. I know very little, to begin with, about what's actually going on in this world of money management, wealth management, and I'm always like, hey, tell me about this, and then she say, okay, this is an interesting product that's come. This is how we do it, and I will always inevitably go back to her with questions about, oh, but how does this work? Oh, but why not? And why? And I think that is actually what how we start unfurling products for our users. Because, and like she says, constantly, like, if you don't understand it, don't invest in it. So the moment we hit one of these snags of saying it's hard to understand, it's hard to explain, we take a step back and say, okay, what can we do to help our users understand what they're actually getting into? And I think from there, Anki, why don't you tell us what we're into?
Yeah, no, so I think I think after product market fit, I think now for us is that we've established that this is, we're building for a particular ICP. Now it is for us to start serving this ICP more holistically. So we kind of got started with one asset class to serve this, and we'll start building with concentric circles. But just in terms of how we think about building, I think some things that we hold very close to our heart, principally true, is that we want to be a very lean team. We want to be product first. We don't want to be RM led as far as possible. We
Yeah.
don't want to be human led. And I think that's those are principles that we will continue to hold on to. So I think for us, for now, is to just put fuel on this fire that we have lit. But just concentrically building around into building asset classes and going deeper into the wallet of
Truly
risk principle.
innovating in the field of wealth tech, because this field is one field which is always throwing people at problems, which we've seen across different banks, NBFCs, wealth tech funds, everywhere, right? But platforms like yours are taking that innovative approach and leading by technology. But one thing that worries me often is that even for my syndicate, and when I see the usual behavior across all asset classes, and we are three women here in investing. The participation on women on the investing side, in especially opportunities where you have the opportunity to create generational wealth, has been historically very low. You see many lists come out with like 100 names. You will find maybe five women who are actually there. It used to be 2%. Now I think it's gone up to 5%, but I would say still not quite there yet, right? So how are you thinking about diversity on the platform, or what can we do as women to get more women into the ecosystem and investors?
I think that's a great question. I think when we raised from angels, I think out of the 40 angels we have about three women, Joy, in our on our cap table. So yes, there is in terms of proportions, like the number of women investors are obviously lesser, but I think there are more and more women who are kind of breaking barriers and coming into the fore with fantastic portfolios. You're one of them, Shrishti. I think you're one of the most sought after syndicates in the country. There are some really nice women-led funds that are actually, coming to the fore. There's Pearl Agarwal of Eximus. There's, Vani's obviously from Kalari's OG. There are new funds being set up. There's a Priya Shah who's building, a fund. Uh, and there are so many women who are coming to the fore, and they've also been stalwarts, right? Like there's been
Yeah.
multiples fund from ICICI has a very prolific lady at the helm. We're Joy and I are fortunate to be a part of this very active and prolific WhatsApp community. It's called the Female Founders Group, and there are so it's only female founders who are in the group, but all of them. Or many of them in their own right are really powerful angels, and you can drive immense value out of these women on your cap table. I think just to add over here, I think women bring in a
Yeah.
very different perspective, and are absolutely great sort of counterbalances to have as part of your cap table. But I think so the trend is changing. But I think, to answer your question, why is that the case? I think that there is a very long-standing cultural, issue that that I think not just India but globally. I think that's the case, right? I think historically, it is only our generation onwards that being part of the workforce or being constantly having your own source of income was prioritized by women, and more so as the generations who are younger than us. So I do think this trend is going to change, but and yeah, definitely a positive trend that that we're looking forward to. I think just to add over here, it's not necessarily to your point on women investors. In at Infinite, we have a leadership of five people, which includes Joy and me. Three people in our leadership are women. So I think we're super proud of the fact that our leadership is female dominated. But yeah, looking forward to more women taking ownership of their own
I
decisions
was
and their own
listening to
wealth.
Joy,
Soumya.
anything you would like to add?
Yeah, I was listening to Soumya Rajan the other day, and I think she currently manages about 45,000 crores of assets. And she pointed out that women investors actually want to understand very deeply the assets that they are getting into. And I think that's something to celebrate. The attention to detail, the depth, the appreciation for nuance. And I think that's probably where, why you have women investors who invest definitely into assets and products that they understand. Like, we've seen so many angel investors, whether it is in SaaS, in D2C, wherever they have depth and they have a deep expertise, we see them coming in, right? Like, it's not that they're not coming in. I think so. I would look at the quality of capital and not just the quantity of capital. I would just focus on that as well. And I think, I mean, we're seeing women operators step up and start companies. This female founder gang, as it's called, it's run. I think we have about six, prolific founders who are admins for it. There's so many other, I think 400 plus people on that group right now, and it's just beautiful to see. Like, every day you will read about either an investment going in, somebody announcing an investment, a company going public, somebody like hiring someone amazing. It's just I think we need to see more of it, maybe out there, but it's not that it's not happening.
Yeah, absolutely. Even I can testify to that. They're similar to that group. There's also a women in investing group, which over a period of time has now grown to 500 women investors. And these are all people who had different funds and, and all stages of funds, be it in the private markets or public markets. So the tribe of women is definitely growing. And, so much more positive things to come our way as well, because this is the first generation where I think women are truly taking charge of managing their own money. And I cannot let you go from this conversation without talking about how you personally manage your own money. So let's talk about that a little bit, whatever you're comfortable sharing.
Anki, you want to go first?
You want me to go first, Joy, or you want to go first?
Ankita.
Okay, I'll go first.
You are the money manager, Ankita.
It
So I
this
think you can go.
it's funnily enough, actually, money
That's
managers are the
true.
worst
I
managers of their
was
own money.
People who know too much shouldn't
Worst.
be the ones
Okay.
managing the money.
Yeah, I think what happens tends to happen. I think is that you have a like you know too much, so you end up with this analysis paralysis mode, right? I think, but I'll tell you, I think, but my foundation towards money management started very young. I was fortunate that my father involved me in a lot of, like, small things, like, since I was little, budgeting, or just understanding what how does how does money in, money out go, and then how should you save. He made me very comfortable with banking transactions, or going and depositing money, or going and withdrawing money, or withdrawing money from an ATM at a very young age. Okay, so I think he took away that fear of money from me before I was 12 years old,
Wow.
or before I was 15 years old, right? Like, piggy banks were, always something that, that I as a child had. I always had pocket money. I always had to do my own budgeting. And I always, if I wanted something, that I had to make it happen with my own pocket money. So I think saving and investing uh, became very internal to me from a very, very young age. And I'm absolutely grateful for that. I think that for the first 10 years of my career, I think I just got the basics right. Okay, I managed to get the right insurance. I also, um, you know uh, just did basic SIPs into the index. I got my PPF done. I think it's such an
Yeah.
underused asset class. I don't know why people feel I think sometimes people think it's boring, but I think it's just so powerful. And so I did the basics right till the age of 30. I think your first milestone to hit is 1 crore. Your first crore is the hardest to hit. Till then, don't deviate, don't try to do something fancy, don't try to do something, don't be a cowboy about it. Try to get to your first crore, because then every subsequent crore becomes easier and easier and easier. I think compounding is, I think, is rightly called the world's eighth wonder of the world. People don't quite understand the power of it, and but to allow compounding to work for you, you have to get your wealth to a certain threshold first. So I think for the first 30 years of for the first 10 years of my career, which means till the age of 31, 32, I just did the basics right. Follow Morgan House's book, right? It lays out a blueprint for it so beautifully, right? Warren Buffett talks about it all the time, right? Just index fund, just invest, into, and be long term about it. get your insurances right, get your basics right, and that's all you need to do. You need to keep it really simple till you get, and then you can start sort of adding layers of risk, adding sort of trying to extract alpha, and starting to get building that risk bucket that we talked about. So I think, so that's how I think of my money. And I actually made my first private investment, I'm going to say 5 years ago, which I talked about as, or 6 years ago, which was one pre-IPO share. That was my first private investment. I made my first angel investment about 2 years ago. So it's this asset class, or getting into these risky assets, is only right at a certain age and stage and a level of wealth. So yeah, I think that's my sort of take on how I think about money.
Yeah, I
Lovely.
think
Joy,
I,
what
I
about you?
actually, it's interesting that I actually started working when I was 16. It was my first job. Was I was a, I was babysitting, and my mom, just drilled this into my head that you need to save. So I think that's when I actually started, and it was the concept of actually earning, saving, spending, and celebrating. Right? It's not just the investing came before the spending and the celebrating. I think that was very core to how I grew up. Started out at 16, like, and just like putting away this money. I think the other thing that I learned, which is from one of my former managers, hey Roy, was don't let lifestyle creep get the better of you. It was very something, we used to always have these conversations, and he always drilled it into my head that you should know how much you're actually going to spend and only stay within that budget. So I think in the last 15 years, like, I've managed to stay in exactly that number, right? It's not changed in 15 years. No, actually 12 years since I've moved back to India, 12 years, right? It's just been that number. And everything else that came above it has always just gone into SIPs and all of the other investment vehicles, right? Then the third was just actually not making any emotional decision, either about my career or about my money. And what I mean by that is it's very easy to get influenced by saying, oh, somebody bought a house, somebody bought a new car, somebody bought something else, and should you be doing this? And it's very easy to just get carried away and then just do something that is not even core to you. Like, I remember when I was buying my car, the guy called me and said, do you want to upgrade your car? And I was like, but why? I don't want to upgrade my car. Like, this is it. This is what I want to, I drive around the city, and this is it. This is actually what I want. Like, I don't want to increase my EMI. So I think that concept of lifestyle creep, not, trying to keep up with the Jonas's, just your journey is very unique and very individualistic to you and who you are. Like, and to not get carried away by what somebody else is doing, right? Whether it's in how you diversify, whether it's with your public equities or whether it's with private markets. Somebody might just have a larger risk appetite than you and not trying to get to something like that. So I think that's basically the principles of how I have done this. And it's interesting that you pointed out Morgan Housel. He talks of how the difference between the rich and the wealthy. And he says, the rich are more status oriented and the wealthy are just more wealth oriented, right? Which is compounding, just building it up. So I think that distinction, and holding that distinction and saying, is this because I want to be appearing rich, or is this because I want to build my wealth? That question is something that I will always confront before I make any investment. Just like Ankita, I think my private investments when I was at Sequoia I couldn't do, obviously, but after I left, I mean, done a few, and these are very thesis oriented bets, or because I love the founder too much, right? So that's how I've done these, and outside of that, I don't do anything that I don't understand, and that's pretty much what it is. And if I don't understand something, like, figure out people, try and get to the heart of it. You don't have to invest right away, right now. Like, you're never going to miss the bus. We're all going to get somewhere. So I think that's the foundation to how I've done my investments.
Thank you for sharing your story so vulnerably and candidly, because there's so much stigma about talking around money, right? Anything to do with money, we don't usually talk about, or it doesn't come up in conversations. But I think, when people hear from other people in terms of how they think about risks and investing, I think that can inform their personal decision making as well. So thank you for sharing those insights. What is your personal ambition for Infinite Club? How big do you think Infinite Club can become? Yeah,
Shrishti, one before we jump into this question, I really want to talk about one thing just for the
sure.
previous question to address, right? I think what we look at, like certain people, Joy talked about rich and wealthy, right? Like, so we tend to look at the you know folks who've been angel investing so much, who become super wealthy, and we look at
Yeah,
them as role models, right? And we say that there is an inherent what you call survivorship bias that exists, right? Looking at those people for their and trying to follow in their footsteps. You're like, oh, this person has made their money because of startup investing, so even I will do startup investing. Please understand that there are enough number of people whose startup bets did not
yeah.
make it, and they have not reached there. So there is, do not circumvent a path, right? Understand what survivorship bias is. Understand that they did get lucky. There is a huge element of luck that they had going for themselves, but they also did the right things in the back to make sure that they don't end up in a really bad place, right? So don't circumvent the path, don't jump the gun. There's a perfect Hindi muhavara which calls us out, and I'm going to say it. It's called "Don't be shaan mein pareshan." So don't try to appear or don't spend money, or don't try to pretend that you have more than
Yeah.
you actually do, right? Like, I think build up your base, and then be wealthy, don't be rich. I think that's the
I think
thought I
this
want
is
to
a
leave
true
that previous
lesson for
question with.
our Instagram generation, right? Everyone wants to talk about where they're traveling, their exotic holidays, or what they've bought recently. So that is a very powerful lesson indeed. So now let's talk about what is your personal ambition for Infinite Club.
Joy, you want to take this one
Sure,
first?
let me
By the
try.
way,
I think
whatever guests say on the show, then it helps them manifest it. So say something that you can manifest, you want to manifest.
no, I think we started out by saying, can we create a million millionaires, right? I think that was where we started, and I think that continues to be true. That's definitely like I would love to see a million millionaires emerge out of India, emerge out of the tech and startup ecosystem. I think that's for sure. I think the other thing is wealth unlocks potential in people like very little else does. It creates a safety blanket, it creates a sense of security, and just helps you live up to your fullest potential and helps you just do things differently, and take bets on yourself. So I'd love to see, I think, more startups emerge, more of our investors turn entrepreneurs, build large companies. Imagine, like, I think every day I wake up and I look at the app and I'm like, wow, all of these companies are being created and they're raising via us. It's insane. Like, I'm at that early juncture. I'm on that, I have that front row seat to seeing some of these generation defining companies being crafted. They're so early right now. It's just two founders, an idea, a deck somewhere, and they're being they're emerging today. So I think being early to that is just beautiful. I would love to see more of that happening. More companies, more founders, more investors. I think the third, and this maybe speaks to a little bit of the comment on the Instagram generation. I think we have to figure out a balance between enjoying our wealth and also creating wealth. Love to see that happen, right? Where we're not afraid of our money, but we also love it and enjoy it, and use it for its best use. So I think that's three things for at least personally.
I think while we're on the topic of manifesting, I think when we started, I think we actually had this conversation. Where do you think this goes? So I think one of, I can't remember which one of us said this, but one of us said this, that we'll hold hands and we'll ring the bell at the NSC wearing a traditional hand woven sari. Maybe 5-7 years from now, I think this is what we said 2 years ago, Joy. I think this is something we said. It's so nice. We saw Ghazal do it recently. So great, so proud of her. But yeah, I think that's where we'll be
More
2 years
power
from
to
now.
you, girls, for leading the IPO wave in the country. I think you'll soon be up there on the stage ringing the bell because of the incredible work that you're doing. I always love to end our episodes with this question about the regret minimization framework, which Jeff Bezos talks about. He makes a lot of his life decisions backwards by looking at himself at the age of 80 and how he would perceive those decisions down the line. So, what do you think your profound insights would be at the age of 80? Specifically, distill it into one significant learning, one regret, and one pivotal life decision.
So even Nandan Nilekani said this, in a recent interview, right? He said that the cost of not doing it is so high that you should do it anyway, right? I think so. I think one thing to, a decision that people um, will regret when they're 80. That's the question, right? What will you regret if you're 80? Right? I think not giving yourself a chance. I think that's something that people will regret. I think a decision that's pivotal is choosing your partner and choosing your co-founder. I think these are two pivotal decisions in life.
One
And what was the
significant
third one?
learning.
Sorry, significant learning. uh, yeah, live your life looking forward, not backwards. I think that's the only thing that at least keeps me going every day. Like as a founder, there are days that they're just so volatile, they're up and down and up and down. And I think that and you have to put a smile on your face, get on that customer call, and convert them anyway. So I think live life looking forward. I think that's been my
Love it.
go-to mantra.
What about you, Joy?
I think what was that pivotal decision? No, sorry, I'm getting
One
this all
pivotal
wrong.
life decision.
Life decision. I think just figuring out the balance between optionality and commitment, and just saying where are you going to play the game and where are you going to just lead with conviction. So not everything needs both in equal measures. I think that's just knowing that and having the clarity around it. So which means having conviction on saying, okay, these are things that matter to me, and I'm going to double down on those, and these are things that don't really matter, and I'm going to let it go. Right? I think that's one. Pivotal, I think, important learning. I do this on a daily basis. I'm like, will future Joy be proud of this? Right. So whether it is having a late night, not waking up early enough, not getting a workout in. So it's always like a question of saying, will future Joy be proud of this, or will future Joy be like, what did you even do? Right. So I think that's the question I lead with. And then what was the third thing? Sorry,
One regret.
one regret. Oh, at 80, I think it'll just be not taking the shots. So I think just take every shot, like just play, like I mean, and just have fun while doing it. I would really regret not playing something to my fullest potential, not having fun doing it. I think that would really hurt. Yeah.
Wow, what a beautiful note to end our episode with. I really enjoyed this conversation. Thank you for sharing your fascinating insights into the world of private investing. I think you both are true powerhouses, and more power to you as you continue to disrupt the wealth tech space. All the best.